Hello, everybody. Welcome to this month's edition of DeSimone Deals, the Exit Strategy Podcast. This podcast is really built to help business owners prepare and plan for their eventual exit and maximize their values and their outcomes and have successful transitions. Uh, and I always bring in guests that can help bring a different point of view to help business owners prepare. Today's guest brings a perspective that every business owner needs to hear. That's the buyer's point of view. I'm joined today by Kevin Baker. He's a director of development at Emergency Care Partners, where he focuses on strategic growth, acquisitions, and partnerships across the country. One of the reasons I love bringing buyers onto the DeSimone Deals podcast is that while attorneys, CPAs, and wealth advisors and M&A advisors can all help owners prepare for the sale, there's nothing more powerful than hearing directly from people who actually write the checks. Buyers give us the unfiltered view of what gets them excited, what creates red flags and diligence, and what separates an average company from one that commands a premium value. Although I'm sure Kevin doesn't want to pay a ton of premium value, but he was going to give us little secrets today. Kevin is in the trenches evaluating opportunities every day. So today we're going to unpack what buyers really look for and what concerns can derail value and what owners should be doing now, years before a transaction, to put them in the best possible position when it comes time to sell. Kevin, welcome to the show. Anything I miss on what you do and how you approach your role?
Yeah, first off, Greg, thanks for having me on here. Really appreciate you having me on as a guest. I've I've kind of been operating in this space now for the bulk of my career, and started out, uh, actually sitting in your seat on the sell side, right out of undergrad, and so I've gotten that perspective, but have now kind of been on the buy side of M&A advisory now, for the greater portion of about a decade. And so I've primarily kind of worked in the multi-site healthcare services space, but really understand through a few different companies now what buyers really look for. And so really excited about the conversation.
Great. So I'm going to jump into this stuff because I'm in the middle of this right now with a couple of different transactions where I'm in diligence and we're making it through, but there's always some hiccups and curveballs. What are some of the red flags that you uncover in diligence that you'd like business owners to know about? Stuff that they typically don't see coming, but generally will always come up when you go through this process.
Oh yeah, it's a great question, and many times it's an area post LOI, right, where deals get derailed. So I've seen it happen multiple times with deals that we've worked on in my career, and you know, diligence is a look under the hood, right? It's really a deep dive understanding to try and identify any risk areas, any successor liability areas where the buyer will ultimately take on an asymmetrical amount of risk, right? And if the roles were reversed, the seller would want to do that as well, right? It's all about protection, right? And that's what we're looking for on from the buyer's perspective, is these asymmetric risk profiles that could really negatively hurt the buyer. Um, and so the big initial area is the Q of E, right? Quality of earnings. And
Mhm.
so a lot of times this entails, pro forma adjustments, right? And really working with the sell side advisor like yourself, and the CEO and the executive team of the seller to understand some of the adjustments. And a lot of it comes down to communication, right? Like, we need to understand from the buy in order to give you credit for some of these EBITDA adjustments, we need to understand how real they are. There's different types of adjustments, right? There are run rate adjustments on contracts that have already been signed and are happening. You just have only realized maybe a partial year of that, and those are slam dunks, right? Where as a buyer, look, if you already signed a contract and you know it's going to increase revenue or decrease cost for a period of a full 12 months, nine times out of 10 we'll give you credit for that. If it's something a little bit more, pie in the sky, a little bit more flexible, and there's a lot of assumptions backed with it, I think there will be a little bit of hesitation on the buyer side. And so, That's what we will do in the Q of E process. We'll understand some of the adjustments, some of the run rate pro forma adjustments. We'll understand cash to accrual. So many sophisticated buyers in at least in the healthcare space will really focus on accrual earnings, accrual based earnings, right? And so our Q of E process really does a deep dive in pulling bank statements, doing cash reconciliations, really understanding what that cash to accrual difference is. And luckily, most of the time, we haven't seen too many issues on cash to accrual adjustments. A lot of it comes down to some of the EBITDA adjustments, right? And giving credit, not giving credit, and so that's really the crux of the Q of E. And I see a lot of times there's a big disconnect in what was underwritten, and what was in the LOI for the transaction versus what ultimately pencils out in the Q of E. And sometimes it could be an issue of material adverse events that happen, just a matter of timing, where from the time that you underwrote and did the LOI to the time that the Q of E was finished, maybe there was just some event that happened in the seller's business that forced the business to deteriorate or maybe, improve. Some of those things happen, right? But I think first and foremost, the Q of E is really the biggest area of due diligence that comes up that are potential deal killers.
What are the type of things like I have I talk to buyers to sellers all the time, and they'll have some other friends or who might have gone through the process and said, make sure you get all your ad backs, make sure you add all the ad backs, make sure you maximize your EBITDA, which I think is comical. Like uh, if you're running your business, your EBITDA is going to be high anyways, whether you have ad backs or not. In fact, I had one buyer recently. We just signed an LOI this morning. He was apologizing. I'm sorry I don't have more ad backs. I'm like, why? He goes, well, I don't have anything to help. I'm like, well, you ran your business clean. You don't have any personal expenses through there. You're basically booking your contracts to GAAP accounting on a percent complete basis. I said, we don't have adjustments because you're in a clean set of books. I think sometimes the owners feel guilty they don't have those ad backs. Tell us about the process, like because just because I write down an ad back or a business owner wants to document an ad back, tell us about the process of like verifying. Like I've heard somewhere, I'll give you an example. Someone said, oh, I have all these tickets to uh, sporting events. Well, I'm in Boston, so it's the Bruins or the Patriots.
Mhm.
And I said, well, who uses those tickets? And they said, well, we give them to customers. I'm like, well, do those customers expect to have those access to those tickets afterwards? Is that part of your marketing approach? Is that they get tickets and they get to spend time with you at these events? Yeah, I'm like, well, you can't add those back saying they're personal
Mhm.
if they're part of your marketing plan and rewards for your best customers. Like, so what are some other things like that where you see it's not just okay, we're mapping the adjustment from cash to accrual and making sure if you're doing a hybrid version of your accounting that works for you to make business decisions, but it's not going to be compliant post transaction for go forward accounting. What are some of the weird ones that say, hey, that you need to clean this stuff up so you don't have a fight on your hands or you don't have an unexpected reduction of your EBITDA when you go into diligence?
Yeah, no, it's a great question. And again, adjustments really fall on a spectrum, right? As to how aggressive they are and how conservative they are. The way that I kind of view adjustments are in really two categories. The first is the category of adjustments that are maybe one time or non-recurring, right? And these are some things that you mentioned about, tickets. And if it is a recurring part of your business, buying tickets for clients, for example, right, as a sales technique, right? Every buyer's a little bit different, but that's likely a recurring expense, right? And so trying to add something like that back may be a little bit of a stretch. And what it comes down to is really just a conversation, right? Like we noticed this adjustment, and as part of our entire process on the buy side, we have in-depth what we call management presentations, management conversations, with the seller's executives where we're trying to understand each of the adjustments, the nature of the adjustment. Many times it includes the sell side advisor in that discussion as well.
Hmm.
But just trying to understand the nature of it, right? Is it one time? Is it non-recurring? If it's truly one time or non-recurring, and it takes a little bit of a conversation to tease that out, um, then yeah, we'll give you credit for it if it's one time or non-recurring, right? But if it's part of your process, if it's a part of your way to retain or attract new clients, it's going to be a stretch. And
How
then the
about,
second, oh yeah,
go
go
ahead.
ahead.
So I was thinking, how about there's some ones where I get in debates with my clients. Tell me how you guys approach it.
Yeah.
I've had, okay, we had to redo all of our internal accounting systems or our CRM or our billing systems. And I said, well, how often are you doing that? I'm like, oh, the last time we did it was 20 years ago and we were out of compliance. We need to upgrade everything to move forward.
Mhm.
Um, the other one I might see is like, yeah, we had to move from, we outgrew our last office space and location. We had to move, and there was a significant amount of moving costs to reestablish. Are those typical one-time thing where there you have to have an office and you have to set it up and you have to have an accounting system or a billing system and tracking system, but you're not re-overhauling them. Are those typical ones that you say, okay, that truly is not going to happen again over the next 10, 20 years? So we can agree to that versus say something like, yeah, we want to have the best equipment. So every 3 years we keep upgrading our equipment. So, and every 3 years we do that. Well, one is, hey, you need to stay current so that people keep coming to you because they know they're getting the current the best of the best of breed. While the other ones are, hey, it's administrative, you have to do it, but you don't have to do it every single year. It's not a recurring thing, it happens. How do you guys look at the difference between those two?
I think it really comes down to frank conversations too around valuation expectations, right? Like
Hmm.
why from our perspective, I've never been a big fan of nickel and diming sellers, right? I mean, look, if there's a certain number that you guys have in mind, let's just talk about it, right? Let's not have this roundabout conversation about I need credit for this adjustment in order to hit my number, hit my EBITDA figure and therefore my enterprise value figure. Let's just have a conversation about it. There are some adjustments where we're happy to negotiate. Maybe if it is one of those gray areas, right? If it's a moving cost, I would say like depending on the frequency, that those are very infrequent. But if it's something like a capital investment in improving your systems and your CRM, that's a little bit more of a gray area in my mind, right? Like you're investing for the future of your business, and so there could be an opportunity to give partial credit as well, right? So some of these
Hmm.
can be negotiated, right? But again, I think it comes down to at the end of the day, why do you want credit for it? You want credit for it, maximize the amount of EBITDA, right?
Hmm.
But is there a number? Is there still a goal in mind that you really want to get to? And working within the confines of that, I think is a very beneficial and healthy conversation. Again, buyers for the most part, like we're not interested in nickel and diming folks, right?
Hmm.
And so if you've got a high confidence in it, let's just talk about it and we'll see if we can give you credit.
You mentioned value expectations, and a lot of times that starts from the first conversation all the way up into the LOI. I mean, you're not, there may be some adjustments as you go through diligence, but if you do it, I believe, and you could tell me if you see it this differently. Um, if the value expectation is set up early, and by the time you sell the LOI, sign the LOI, you've already come to an agreement what valuation expectation is, and the diligence can really just be, hey, we're confirming what we told you, what we showed you to make that offer. And as long as nothing's different, that offer should stand. How do you go about setting at valuation expectations with your clients and going through that process?
Yeah, so value is really driven by a number of different things, right? But it's
Hmm.
mainly a combination of financial performance, risk profile, and future growth opportunity, right? That's the way that we look at it. And so the starting point for valuation is always earnings, right? But to take it a step further, high quality earnings, which is often measured by, EBITDA, earnings before interest, taxes, and depreciation. And as a buyer, we want to know how reliable and sustainable those earnings are, right? The last thing that we want to do is buy a business that's doing $1 million of EBITDA. There's a bunch of adjustments on there or non-sticky revenue. or an inflated, inflationary cost structure. And after year one post close, it's $500,000. That would be a very bad outcome from a buyer's perspective.
Mhm.
On the risk side of things, though, right? The things that
Let's stop for a
we,
second. You made
yeah,
three, I think you had three good points here. This financial performance, risk performance, and then growth. Let's talk about each one. And so high quality, you mentioned sticky or recurring. What makes it like, so I'd imagine it's more valuable if you have businesses that have contractual revenue that you know is going to recur year after year versus someone says, okay, people just continually buy from us. Like, is it the same customers that always buy from? Like, no, but people just show up. But we always do well. Like, so there's like, hey, we're starting at zero every single day, but we're relying on our sales and marketing. Or versus, hey, we have a contract, and this revenue that we have today will be here at least for 2 years, 3 years, 4 years. So is that kind of where you're talking about the quality? Is like how reliable is that it's going to show up every single day or every single quarter, every single year for X period of time versus, hey, we just have a good process and we know it's going to eventually come. How is that how you distinguish it?
Yeah, on the stickiness side of things, what we look at is contract tenure, for example, right? So
Hmm.
how long have you held the contract? If you've held it for 4 or 5 years, that looks a little bit different than if they've held the contract for 20 years, right? There's a higher likelihood maybe of them, signing back up and continuing that contract. And then contract terms as well, right? Is it a 1 year contract? Is it a 3 year with a annual auto renewal? The terms of the contract really matter as well. So we tend to do a deep dive on the contract terms as well, just to
Hmm.
understand that. And then the other thing that we kind of look at too is client satisfaction. And there's a number of different ways to look at that, but one of the most widely accepted is kind of net promoter score, right? So how
Yeah.
likely are you to
Explain that promoter
refer?
score for some people that may not know that.
Yeah, net promoter score. How likely are you to recommend the product or service to a friend, right? And it's basically a survey on a scale of 1 to 10. 9 and 10 are what they call promoters of the product or service, and then anything less, I think 1 through 4 or 1 through 5 is a detractor, or anything less than 9 is a detractor, but you want to get that 9 and 10 score in the NPS. And so that's a good indicator for us as a buyer. Hey, if your clients are scoring you a 9 or 10 and you've got a net promoter score that's over 85%, that's a positive indication, right? That they like your service, and they're likely to renew it, right? And so those are some of the things that we look at from to understand stickiness a little bit.
Sure. So financials is how reliable are the financials that you're acquiring? Will
Mhm.
they continue? Um, Next thing you talked about is the risk profile. What are some of the risk factors that help you determine? Like, for example, I tell clients you have $2 million of EBITDA.
Mhm.
The range is going to be, and I'm going to pick random numbers here. 4x to 6x times earnings is going to be your valuation rate.
Mhm.
If you have a less risky profile, you may get the 6x. If you have a risky business profile, you're going to get the 4x. So you have the same amount of earnings, but these risk factors will determine where you are on that line. Is that consistent with how you look at it? And then how do you determine the risk factors that are important to you guys?
Yeah, you're spot on there, Greg. Yeah, usually there's an inverse relationship between risk and multiple, right? The more risky an asset is, the lower the multiple, generally speaking, right? And so, in the healthcare space, we look at a number of different things from a risk perspective. One of the things that we look at is, is the seller overly reliant on, subsidy payments, or are they reliant on locums usage, for example? This is more of a healthcare specific thing,
But
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 are
like, so
they?
give me an example of what that means
Yeah.
and to someone, like how that affects the risk for them.
Yeah, yeah. So would you rather have a business that is getting some additional financial support from their client to maintain a profit margin, or would you rather have a client that has no financial support from their core client? I would pick the latter, right? Because they
Mhm.
can generate a profit, generate a return without having to receive financial assistance from a hospital, for
Mhm.
example, right?
Mhm.
And that's it goes back to contract stickiness, right?
Mhm.
If I'm a hospital and I outsource my emergency department, for example, and I have an option of signing a group to manage my ED, but they're asking me to pay them $1 million a year for them to kind of break even. On the other hand, you've got a group that requires no financial assistance from the hospital and says, "Hey, we can actually because we keep our cost structure lean because we have superior billing practices or really good managed care contract rates. We don't need any financial assistance from you, the hospital. We can generate a return without that." Um, that group that I just described, the latter group, um, their risk profile, from our perspective, there's less risk with that business, right? There's less risk as opposed to a group that has to receive subsidy payments because hospital administrators are very much compensated on operating margin. How
Mhm.
well is the hospital doing?
Right.
And subsidy payments, decrease their earnings potential from the hospital perspective, right?
So that makes sense, and just to bring it, make it a little bit broader for everybody. So,
Yeah.
for example, like if you have an emergency department that can run self-sufficient, if someone says, "Hey, I want to acquire that, they want to sell it," you can move that anywhere because you know exactly what it's earning because it's self producing all its own revenues and expenses and its profit. It's not relying on any third party to supplement
Hmm.
their performance. Well, if you have the hospital saying, "Hey, we're going to subsidize $1 million to cover your operating costs just to make sure that you can cover your overhead," you pull them out. You don't really know what they can do on a self-sustaining basis because they have never done on a self-sustaining basis.
Yeah.
There's more risk related to that. For other folks that are listening, I had a similar company that was getting credits from the government for renewable credits.
Yeah.
But no one knows when depending on who's in charge in the government, some people are favorable to green credits, other administrations are not. So if you're relying on a government
Yeah.
subsidy, and you don't know how long that will stay, and if whether the political environment's going to stay the same, that if you're relying on as much as more, the more reliant you are on that subsidy, that credit from a third party, the less reliable and the more risky your revenues are, your earnings are.
You're absolutely right, Greg. Yeah, you hit that spot on. You hit that spot on. Yes, less reliance on any third party subsidy is always better from
Are
a private
there other
perspective.
risk factors like do you look at infrastructure? Do you look at management team, employee? Like what other risk factors do you do to build your risk profile?
Yeah, we look at contract concentration, so client concentration. And
Okay.
so,
What's a
you
what's a
know,
big number for you? Like when it gets above a certain point, when do you start to have to take consideration of that on pricing and or deal structure?
yeah, if 100% of your business is focused on one client, that has a very different risk profile than if you have two, three, four. And it depends on how you slice the data as well. Is it, the best barometer is, client concentration as a percentage of earnings, like what's actually driving the earnings, not in terms of number of sites or by revenue, but
Mhm.
what is really driving the earnings concentration for your clients, right? And that's the biggest thing that we look at because in healthcare, I mean, you could have 20 different sites of service,
Mhm.
but maybe there's only a few that are really driving the earnings potential for the group, and the rest are loss leaders, right? The rest
Mhm.
get you a foot in the door to grow and expand, top line. But at the end of the day, it really comes down to earnings, right? What is really driving sustainable, profitable earnings? And that's how we kind of view contract concentration in that regard.
So it's easy to say like if what would an easier question would be, okay, if this relationship went away, what does the company look like? What does the organization look like afterwards?
Yeah.
If that organization went away and things pretty much run smoothly and are the same, the all profits and the margins are the same, okay, it's less risky. If you're over relying on one relationship or two relationships, that determines whether you can either acquire them at all, whether you
Yeah.
need to reduce the price because of the risk, or you have to defer payments to make sure that risk can be validated and mitigated over time. Is that correct?
Yeah, no, that's spot on. And again, it really comes down to in the space that I operate in. I always say you're only as good as your contract term, right?
Hmm.
Once that contract comes up for renewal, the hospital administrators decide to renew the contract with you, or they decide to put it out for RFP and try and bring someone else in, maybe that has a lower subsidy reliance, right? Again, going back to that concept. So it really comes down to down to that, and yeah, like the other example I'll give is when we partner with groups, we offer equity within our business at the holding company level. And our company is, we see about 1.5 million patients a year across 65 emergency departments. We're in 10 states. So that risk profile looks very different from a contract concentration standpoint compared to the emergency medicine group that only serves one hospital in one
Hmm.
state with one hospital client.
Hmm.
If they lose that contract, right? If that contract is coming up for renewal and hospital C-suite turns over and there's just a different view on who to outsource the ED to,
Yep.
and they decide not to renew it, well, that business that was doing $1 million a year in EBITDA is now worth nothing, right? They don't have a business anymore because they didn't get their contract renewed.
Hmm.
Um, as opposed to when people partner with us and they get equity within our company, they now are an owner in a business that's in 10 states, with 65 emergency departments. So there's a diversification aspect and a risk aspect in that regard.
I'm going to go back to the equity and the structure in a second, but I want to follow up on the last item you were talking about in risk profiles is growth. How do you evaluate growth, and how does that change your perception of a company and or an organization and what you're willing to value it at?
Yeah, no, it's a great call out. This is sometimes where we butt heads a little bit. Sellers love to get credit for something for some of the growth, right? And it's probably something that I see in every book is, it's a large market, it's growing very fast, it's heavily fragmented, and so it's all kind of speaking to some of the things that
Which is
around
why you're
growth.
already there,
Yeah,
because you see
right.
that.
Exactly. Yeah, no, I see it all. I see it on every book that I look at. And the big point of contention is typically, hey, does the seller want credit for the growth or not? Is it already contracted? Is it already executed? Is it penciled already? Or is it just, a Hail Mary kind of thing that they're throwing out there that they want credit for? And ultimately, just like valuation, right? Growth is kind of in the eyes of the buyer.
Hmm.
And so if the buyer believes that there is room to expand to new sites or that there's cost savings opportunities, that's really in the eyes of the buyer. And so if the buyer believes in that, in achieving that growth opportunity, um, then we may pay an extra turn or more for that business.
When you say
Um,
turn, can you just clarify what you mean by turn? So,
Yeah, an extra multiple. So, if it's really, really strong growth profile, we may pay an 8x instead of a 7x,
okay.
right?
Yep.
Um, and so, yeah, usually we're not, there's a fine line between growth prospects and synergies. Usually a buyer is not going to pay for synergies that the buyer has to do the work on to actually achieve those synergies. And
Explain that.
so,
That's what I have this conversation all the time with my
yeah.
clients. I said, "Oh, if you get someone with more money, they can spend some money on marketing, they can spend money on infrastructure, and there's going to be a lot more growth." I'm like, "Well, if you, my argument is like, if you've set it up and they just got to keep cranking the wheel, and they don't have to spend any real extra money, then yes, that you should probably get credit for the growth because you set the platform up. If it is they got to spend $250,000 here, they got to spend another $250,000 there, and they got to keep spending extra money to achieve the growth that you say is there. Well, then that's part of actually the purchase price. It's what they're paying you
Mhm.
plus those costs. Is that how you look at it? Like how much money do we have to and effort do we have to put in to deliver or to achieve the growth they say they're delivering, or is it really just continue the momentum so that you just collect it as it goes? How do you look at that?
Yeah, usually it's slam dunk synergies, right? Like it's things like mainly cost synergies, right? Because Revenue synergies tend to take a lot of time, effort, and work to really achieve, right?
Mhm.
Like if nothing's penciled or contracted and executed, it's going to take the seller's time, it's going to take the buyer's time to really be able to execute on revenue synergies. So revenue synergies are a little squishy. Cost synergies, though, many times for a buyer, these are slam dunks. These are very easy things. It's taking you from the seller's contract, moving it over to ours. We're not, you as a solo seller would not have access to this larger contract that has a lot of economies of scale, right? And
Mhm.
so that's really something that only the buyer can bring to the table.
Mhm.
And so in that regard, we're not going to pay you for that, right? That's how the buyer helps to kind of recoup our money back, right? When
Mhm.
we're paying out, 6, 7, 8x on earnings. And so, yes, usually on cost synergies, those are the biggest slam dunk for the buyer, and we're not in a position to really pay for that. But on revenue synergies, look, we may structure things like if you can help us really sell and get this new contract, for example, we'll pay you an earnout on that. It's not going to be at the same multiple that you transacted at close, but
Mhm.
it'll be, maybe 3 to 4x, right? And at transaction close, we transacted at 8x. So it's kind of a win-win. If you help us sell it, we'll pay you for it. So we've done some things like that in the past.
So that kind of leads into that structure question. You mentioned earlier that you provide equity to the owners.
Mhm.
Yeah, sometimes you have an earnout where I'd imagine you're using that to. Or why don't you tell us how you look at the structure? And I typically say there's cash, there's rollover equity in the new entity, there's earnouts, and I don't know if you guys use them, but I know in other transactions there's sometimes seller's notes to bridge a gap. I don't see those as often, but that's probably the fourth element of structure. Is that those are the elements of structure that you use in your transactions?
Yes, largely speaking, I think seller notes tend to be on smaller
Yep.
deals, but
Yeah, I don't
we
see
don't
them
we
often, but I'm talking to everybody.
yeah, we don't typically deal with seller notes, but yeah, it's for us, we really structure our transactions as cash and equity. Right?
Okay.
Those are the two biggest, functions. Earnouts we will leverage, right? But
So,
we need to do it in a compliant way that fits into the regulations as well. There are some regulations that really
mhm.
restrict some of that, especially in the healthcare space. So we always do that in a very compliant way. But yes, we do use earnouts.
So talk about how you determine your split on the structure between cash and equity. So those are your primary tools, and that I see that on a lot of deals, particularly if it's a larger strategic acquirer or if there's a private equity
Mhm.
financing or backing a strategic acquirer. So how do you guys look at leveraging cash and equity rollover in your transactions you make these offers?
It's a negotiation. It's a negotiation point, and we always, I think it really ranges anywhere between 60% cash, 40% equity to 75% cash and 25% equity. It really depends what the motivations are of the seller. I'm going to go back to that as well. Are the shareholders all aging, retirement age, and really just looking for that big cash windfall? They may be, if that's the case, they may be more motivated to take more cash, right? Be at that 75% threshold of cash as opposed to 60%. On the flip side, are the shareholders maybe a mix? Are there maybe some retirees, but maybe there's a lot of early to mid careerists that are really looking, they really see the equity value as a very exciting opportunity to double, triple, quadruple that equity component in a very tax advantaged way. And so, if that's the case, right, they may be more incentivized, they may be more inclined to take on more equity, right? So it really comes back to partially a negotiation, but
Hmm.
also understanding some of the seller's intents, right? What are they really trying to solve for? Are
Okay.
they trying to solve for, a net pre-tax cash number, right? That's something
Mhm.
that I always come across, right? It's not
Yep.
There's a big difference, as you know, Greg,
Yeah.
between the headline enterprise value number and what you're actually going to get in your bank account, right? And so many times docs are like, hey, I want $1 million pre-tax cash, right?
Hmm.
And so then you got to work backwards from that, right? You got to be like, all right, what's the cash equity split? What's the escrow? What's the networking capital look like? And then you start to kind of get to that pre-tax, net pre-tax cash number. And look, I mean, we've lost deals on that because some advisors, the seller's advisor failed to educate them on things like escrow, things like cash free, debt free, things like
Hmm.
networking capital. And it's never a good look. It's an opportunity where reputations get hurt. If you go down to the 11th hour and their seller advisor just didn't educate them on, hey, things like escrow, right?
Yeah.
And what's actually going to hit your bank account at close. So,
So when you talked about this, it's anywhere from say 60/40 cash to equity. It could be 75 to 25, depending on the needs of the seller and the owners. And I'd imagine like if they want more cash, it's not like okay, it's not like you have 10 million. I'm just picking an easy number for math. Just it's 10 million. It's not like, oh, do you want 60/40, 6 million cash, 40 stock, or do you want 75, 7.5 million and 25? The more I'd imagine the more cash they want up front, that not only affects the mix, it also may affect the total valuation because you're having to assume more and more risk because once you write the check, you have less
mhm.
clause or connection. Clauses are a bad word. Connection to the ongoing relationship with the owners that will keep the business running as it did before. Is that correct in my assumption?
Yeah, it could certainly have an influence. Yeah, I would say we always start out, we'll start out at a certain cash equity mix. And then if that's something that the buyer or the seller really cares about, then we'll negotiate it, right? But most of the time, you know, we'll go out with an estimation on EBITDA. We'll go out with, our initial offer on multiple, and that'll get you your enterprise value. And then we'll go out with initial cash equity mix. And so as they say, everything in life is negotiable, right? You negotiate the multiple, you negotiate the cash equity mix. It's really gonna, that initial counter proposal by the seller will be very telling, right? To understand what's truly important to them.
Hmm. So you mentioned a few minutes ago about earnouts. So earnouts are not really part of your general playbook going into it, but occasionally they come up. So typically, what is the role of the earnout in a negotiation for you guys? Like, so if it comes down to it, like, where are you using it? Is it to bridge a gap
Yeah.
on valuation? Is it to when you can't come to agreement on a risk factor that hey, okay, we can't agree on this, we'll go to the state of Missouri and like show me, and you can get it. If you don't show me, you don't get it. How do you guys use it?
It's mainly used to bridge valuation expectations for the most part, right? And so I think we might have alluded this earlier, but sellers love to talk to each other, right? And business owners love to talk. And one business owner will say, "Hey, I got a 10x for my business. I got $10 million for my business," and a seller hearing that is like, "Oh wow, 10x. That's what I should get. I should get 10x for my business." And so they have these preconceived valuation expectations in their head, but your business could be very different than your friend's business, right? The risk profile, the growth projections, the financial stability, the stickiness that we talked about, that could look very different. You really don't know, what your friend's business is and all the factors that went into that. And again, unless you're dealing with the same buyer, right? Value is in the eyes of the buyer, right?
Yeah.
And so you could be dealing with two different buyers, right? That
Mhm.
that view your business very differently.
I
Um,
also looked at too is that when I hear that the trophy number, the country club number, and
yeah.
you're dealing with medical professionals, doctors. So I play golf with doctors. Uh, that they don't know. Yeah, they don't take into account it's not apples to apples. It's apples to pineapples. Sometimes we're like, hey, did you have personal expenses running through that you backed out? I'm like, well, if you
Mhm.
did, are you using your adjusted number or are you using your book number? Your book number to calculate your multiple may be a 12. I actually had a company, they complained they weren't getting a 10x. And I said, well, you got 7.8.
Mhm.
Yeah, but I know people that are getting 10. I'm like, well, if I take your as reported numbers, you're getting 15. But on your normalized numbers with the adjustments that we can prove, you're getting 7.8. I
Yeah,
said, what did your friend have for ad backs? How did they make those adjustments? Well, I don't know. I'm like, well, we can't compare if we don't have the same starting point.
yeah.
So I imagine that's what you have to deal with that a lot is like dealing with that the expectations from the friend or the country club valuation, which is not really an apples to apples comparison.
Yes, we deal with that all the time. And sometimes it comes down to just asking the very blunt question, what number do you have in mind? Right. And if we're just open and honest about that, we can either find a way to figure it out, or we'll say, look, we just have to part ways, or this is just not going to work for us. Right. And so, the more open and honest and communication, I think is work, has seen more positive outcomes in my experience.
And let me ask you this. I think I know the answer, but I want to have my audience hear this. If it's not going to work out, you're trying to figure that out before you sign the LOI. You're not hoping to change everything during diligence. Just saying, hey, I want to come to agreement. I want to know that we're moving forward. I'm looking forward to moving forward. Is that when you do it,
Yeah.
or do you use diligence as a negotiation?
No, there are no.
So you do not use diligence as a negotiation to reduce price.
No, absolutely not.
I
And I
don't
know
listen
that
to
might be a
that.
shock. That might be a shock for most sellers to hear.
It is a shock. Everyone thinks they're just going to come back and I tell people if you do the job up front and you provide the right information, you answer the questions transparently, have reasonable expectations on what your needs are and your valuation is expectations are in the timing of when you need to see the cash. Um, you can probably solve 90% of your problems before you even get to diligence. Diligence will bring stuff will come up. I mean, it always does, but it should be
Yeah.
little issues that you have to just manage versus okay, we have to reevaluate everything because what we just found.
Yeah. Diligence, you mentioned this earlier, is confirmatory due diligence. It's just to confirm everything that we agreed to and looked at pre-LOI.
Right.
That's all it is from our perspective. And one thing I would highly recommend any seller that's out there thinking, understand the buyer reputations that are out there. There are some buyers that are just looking for information. They're just looking to get smart on a particular industry, and they don't really have a motivation or conviction to really close on a transaction.
Hmm.
There's a lot of buyers out there that are just fishing for information.
Yeah.
Un- so if you're working with someone and your seller advisor can really help with this, they can talk to other sellers that have gone through a transaction with this buyer and really understand their reputation, their motive. Because for us, most of the companies that I've worked with, on the buy side, if we are signing an LOI, we're ready to close. Like we know you are the partner that we want to work with.
Say that
It's
again. Say that again. When you sign an LOI, what are you expecting?
we're expecting to close. We're not like we expect to close. And a lot of buyers handle this very differently. A lot of buyers do a lot of work up front pre-LOI. They'll
Hmm.
even start working on integration related stuff before LOI. The company that I work for right now, that's us. We tend to do a lot more work up front to really minimize the amount of unknowns out there and open items. We tend to do a lot more work up front pre-LOI to give us that high conviction that this is the partner for us, we want to close. So when we're signing an LOI, as long as everything's penciling out and the numbers match what pre-LOI, we're ready to close, you know?
So we got a few minutes left, and there's one thing I wanted to talk to you about is more of like how do you make yourself attractive to a strong buyer, and your company's a strong buyer. Um, So what makes a company attractive to you that you want to you're going to show interest versus one that you're going to pass on versus a third one is like not only do we like this one, we love this one. So how do you go from pass, like and want to explore to we absolutely love this and we want to move forward. We know we want to move forward. How do you and maybe you have different buckets, but how do you go through that evaluation to put them in those buckets? What do the companies look like and to help you sort them through that decision process?
Yeah, I'd say first and foremost, I think strong leadership, right? So understanding, who the operator is. Is he a really strong operator? He or she is a strong operator. Understanding the leadership. And then double clicking into that, the succession planning aspect, right? So if the seller is really looking to transact and sail off into the sunset and drink pina coladas, that shows to the buyer that you're not really in it. You're not really trying to make this a win-win for both parties. And buyers will really appreciate that, and they'll pay a premium knowing that you've got a deep bench or you're willing to stick around, 2 to 3 years post close to manage the transition. When you close and execute and wire funds on closing date, there's things don't just magically happen from there, right? There's a transition plan that needs to occur. And so having open and honest discussions around that, how many years are you looking to stay on board? If you're looking to actually stay on board for 2 to 3 years post close, that is something that we view very favorably as a buyer. Um, and the other big
So
thing I
you'll
would
pay more if they're willing to stay on for a reasonable period of time to help make the transition more successful
yes,
versus
absolutely.
they want to get a check and go retire.
Yep. Yep. And I would say too, the less reliance that the if your business is less reliant on you personally managing and operating and growing the business, that's a positive, right? If you've got a bench of leaders that can manage the business day to day, and you're in Florida half the year and your business is in New York, that's actually a positive thing, right? And maybe we won't require you to stay on for such a long period of time post close. If you've got a bench of people that already do most of the work and do the selling and don't rely on you for the relationships, that's a very positive thing. And so if you're thinking about a succession plan or exit strategy, start thinking about delegation today. Start thinking about sharing the relationships. Start thinking about building a team today so that the business is less reliant on you.
So you mentioned earlier quality of earnings and having stickiness is important. The depth of management and the less reliance on an owner is important. Is there any other key factors that make someone really attractive to you that you want to acquire them or you decide that you can't acquire them for whatever reason?
Yeah, I would say the other big thing is just kind of getting into some the litigation. I would say is another big thing. Is if there's open litigation or in the healthcare space, if there's open malpractice claims, that can be a really good indicator for clinical quality or anything else that may be a big issue. And then macro trends too, macro tailwinds and headwinds. In the healthcare space, there's a lot going on in rural healthcare. There's a lot of dollars. Payer mix is really shifting in that space as well. And so, there's been a lot of assets that I've seen coming to market that are really focused on rural medicine. But it's really challenging. It's really challenging to get anything done in the rural healthcare market because there's provider shortages, payer mix is very unfavorable in those geographies, uh, on average. And so understanding some of the macro headwinds is really the other thing.
Any final thoughts before we wrap up that you'd want a buyer, excuse me, a seller to know that make the transaction with you more seamless and more attractive?
Yeah, I would just say first and foremost, get yourself a good advisor in your corner. Don't try and go at it alone. Yeah, and this advice may be very counter to my own interests, right? Because as a buyer, we love proprietary deals rather than a banker or broker-led deal.
Mhm.
But having an advisor in your corner who really understands deals in your industry is key. And that can be a CPA, that can be an attorney, that can be a sell side advisor, but get good advisors and build the right advisory team early on.
So I know this for a fact, um, but explain to them why you want your the companies you're acquiring to have good advice. Why is it important for them to have a good CPA, good attorney, and hopefully someone like me, a sell side advisor? Why is that important to you as the buyer?
One word, speed. If if you've got all your ducks in a row, you're organized, you've got a team behind you, yes, it may cost you a little bit of money, right? But we're going to be able to close this thing a lot faster. And buyers love to be able to execute and move fast. If we can move quickly and you've got an organized set of financials, you've got all your legal documents, in a data room already completely organized, we're going to be able to close this transaction faster. So it really comes down to speed.
And would you say the faster you can close, the less likely something could come up that could derail it, whether it's internal or an external factor that could change the market?
Yeah, absolutely. I think, right? I mean, buyers need to be able to do their process though. I
Mhm.
will caveat, like
Yep.
when the seller is trying
Speed
to
doesn't mean we're going to
dictate.
do it in 3 days. It means
Yeah,
we can do it in 60 to 100 days, or say 90 days versus 120, 150.
yeah. Look, if it'll depend on the market, right? And you
Yeah.
know this very well, Greg, right? If there's a lot of buyers, and you're running a process, you've got more leverage probably,
Mhm.
right? And you can probably speed up the process maybe a little sooner. It's like buying a
Mhm.
house, right?
Yeah.
You're gonna buy it, and demand an inspection, or you're gonna go without,
Mhm.
forego the inspection, right? If you're a seller in that sense, you might go with the buyer that's willing to forego the inspection, right? And so, very similar in our space here.
Well, Kevin, we're up against the top of the hour here. I really appreciate your time and your insights. This is going to be very useful to the listeners and viewers of this podcast. Um, And everyone, if you want to learn more about Kevin and his business, and if you think you may be a potential target for him, his information will be provided at the end of the this podcast on the last sheet. So thank you very much, Kevin, for joining us. And anyone who wants to reach out to Kevin, you'll have his information at the end of this podcast. Thank you again for joining us, and I'll talk to everyone next month.